you see my screen and hear my voice? Yes. Okay, how's it going? Charles, Bala, David, Greg, Coke, good to see you. George, hope you're feeling better. All right, well, we have part 2 of Doug, and we know he's got lots of information to share, so let me knock out this disclaimer, and we'll get going. Nothing presented in the webinar or video presentation, either vocally or visually, is to be taken as trading advice. All of the everything in the presentation is for educational purposes only. Any trades you take should be your own decision. It's fine to take input from other people, but it's your money on the line, so make sure you understand why, and do not risk money you cannot afford to lose. And with that, I will hand it over to Doug. Let me make you the presenter, Doug.
All right, thank you very much. How's everyone doing tonight? Hey, Greg, how's it going? Bob, Jurgen, Jeremy, Dennis, Ray, George, everyone. Awesome. Glad to see you all. Everyone can see my screen, right? And obviously you can hear my voice. Yes, okay. I had a bit of a computer error last night. Transformer blew. I thought I lost my computer with the surges and whatnot. Had a bit of a trouble actually getting it started. Wound up losing most of the presentation because I had it open when I went to bed. I didn't save it. I was foolish. I spent most of today like trying to restructure my presentation. So I hope it's up to snuff. Yeah, that's it. All right, so let's just get going on this. Let me just move this stuff over here. Do have a lot of material, so we'll get right into it. All right, this is obviously swing trading too. Second part of last week. Now, there's a lot of confusion. First, I'll talk about what we'll be talking about tonight, and then we're going to do a small amount of recap from last week, okay? So, first of all, the homework and the confusion. Basically, a clarification of the H4 concepts and, confluence of events. I'll be showing multiple examples. I'm going to go to the platform and do stuff on there. But, fortunately, Jim covered confluence last night, so I don't really have to explain it too much, so he saved me a couple slides there. Thanks, buddy. Identifying the phases of the market using the D1 and the H4 using TDI and moving averages. Okay, this will kind of get into what part of the confusion was about, but it's fairly straightforward, and it's going to help you to really get a sense of how you should be trading. All right, so we're going to be covering how each cycle of the market behaves. And like I just said, I should probably click forward before I keep talking. How that's going to determine your approach to trading on the lower time frames, okay? Use a lot of initialisms and abbreviations and acronyms, so bear with me. You'll get used to them. TDI analysis on the H1 and the H4 and why you need them in tandem, like why you should be paying more attention to the TDI than you actually are, okay? Yeah, obviously, we'll be talking about setups, but again, they're really basic. Level 1 safeties, level 3, head and shoulders. Those are your bread and butter. Second legs, larger structures. Trade management as far as your TPs, bailing and scaling and stops. I mentioned some of this stuff last week, but tonight we'll be covering it in some more detail. And of course, developing your vision. And that goes back to the homework and the confusion. A lot of people said I didn't really know what I was doing. Well, that was the point. Again, what I won't be covering is the M15 entries, anything M5 or M1, and of course the risk management. This kind of came up a little bit this Sunday. Nothing has changed. If you're doing a 50, if you're grabbing off the H1, and I'll show you why you shouldn't be doing that to start. 1% is still 1%, 3% is 3%, and so on. It's been covered, and it was raised this Sunday, and Manal, if you're listening, I believe that was Manal. I hope I didn't come off like I was mad at you or yelling at you or anything. I wasn't. I was just I kind of get worked up, and I hope you weren't offended by that. But my point was that it doesn't matter when you've done the homework, you've internalized it, and to quote Steve Morrow, when you're right, a stop a stop is irrelevant, a stop doesn't matter. You should still be using them, but the point was at the dollar CAD entry long last week, he noticed, he's like, you're going to have a 50 pip stop, and exclamation point. And another issue was raised about, well, you're going to need X amount of risk to reward, and you're going to need at least 100 pips just for 2-to-1. You got to remember what we're doing here. This is that 15-minute mentality. We have a lot of people here who have a job, a family, and other obligations that they can't be up for London. If they're in the U.S., they got to work during the day. When they're working, they can't be watching the New York session. They can't be up in the middle of the night because they have to work, and the spouse is like, what the hell are you? This is ridiculous. If they try it, they're working all day, they're tired, they get home, they want a nap, they can't be with the kids. There's a lot of stuff. So if you can learn this stuff in the H1, the H4, and you happen to spot a 50, this nameable pattern, second leg on the H1 with divergent, everything is lining up as to what I'll be showing you, and you can take that and be confident, and it runs for 100 pip, that's okay. Maybe that's 2-to-1 risk to reward if you're only taking 100 pips, but that's still 100 pips more than you would have got by not getting up at London and not being able to be in front of the computer. So that's the goal here that we're trying to cover. Okay, so with this risk management, and oh my God, the stop is so big, think in terms of the people that really kind of are required to do this because they just can't be up in London. And to them, hey, maybe grabbing 100 pips for the 50 pip stop, that's something they might need to do. But still with proper risk management, 1%, 2%. That's still more money that they were making by not getting up. Okay. So all that stuff I just talked about, the M15, the M1, the M5, same thing as last week. There's people much more qualified than I to cover that stuff. I won't even begin to answer a 5-minute or 1-minute question. I will just be like, you know what? Go talk to Amir, Paul, and Ted. Those are the guys. Okay, so first off, here's a list of everyone that handed in the homework. Thank you guys. Fantastic. Everyone had some concerns. Pretty much everyone included in their message, it's probably wrong, not sure this is right, I didn't know what I was doing. But you all took the leap. You all got some stuff done, okay? And a lot of you got more right than you think, okay? You're seeing this stuff, but you're still on that precipice of uncertainty, gee, is this right? Because there's no, 2 + 2 = 4 no matter which way you cut it, okay? There's none of that. So you're left to your own devices, and it all comes down to familiarity. And I know you're not familiar with the markets yet, and the H, especially at the H4, and then going down to the H1 and just looking at those because there's all the focus on the M15. So it's understandable. But you guys all took that leap. That's awesome. Congratulate you, and hopefully the rest of you who are interested after this week, you'll know what I'm talking about. Because I'm sure a lot of people wanted to hand in the homework. They sat down in front of the computer and they said, I don't know what to do, so I'm just not. So hopefully your name can be there at the end next time I give a presentation. Okay, first, before we get going, one person, Tim McDonald, awesome. I just wanted to say he's one of the students that did the homework. Do you notice? There he is, right there up top. He's one of the first people. Handed in the homework. Took a trade based on what he learned, what I've talked about, and I barely covered the stuff last week. I did a lot of fundamentals. He took the GN short yesterday with a confluence. He grabbed the tight entry, okay? I'm showing you stuff on the H4 and the H1 primarily, but, he saw it, and he listened to what I said last week about dialing down. And he went down to I think the 1 minute, He studies that stuff. Got a really tight entry, held it for 2 days. Got 331 pips, got it at a confluence area, which was nice. We talked a little bit about it, and he nailed it, all because he did the homework. All right, and I'll take a brief, just to take a look at it, so you can see. There we go. Confluence, quarter point, right up to the top. I think he waited for this pullback into this region. Is it confirmed? No, your confirmation over here, but he was looking for those confluences and trying to nail down on the M1, the M5. held over to here, got out. Confluence area happening over here. If you can see the blueberries pulling in to the psych level, okay? It's going to be one of the things I'm talking about. So just want to point this out. You know, guy never really did the H4, H1 homework before. He just did it for this week, and he came back with that. So this is the power of this stuff. They even said, he's like, man, 1 or 2 of those a week, I'm fine. So, okay. Now, let's just address the confusion. Oh, you know what? I'm probably going to skip this right now. I'll include this in a link because I have a lot of abbreviations that I use. If you just want to take a screenshot real quick, bam, and save it because I'm going to skip this in about 5 seconds. All right. Now, if need be, I'll come back to it, but I'll also post it with the video. This is all abbreviations you'll encounter with the TDI. I'm all about efficiency and saving time, so I use as few vowels as possible, as you can see. Okay. The three I received was one, sure I'm doing these H4 levels correctly. Pretty sure my count is off, okay? Pay attention to that. Wasn't sure what you meant by confluence. Did you cover that? Yes, I did. And 3, not really sure what you meant by a baseline bounce. Did you mean a cross? Not sure I'm doing this right, etc., etc. Okay. So, why were you confused? I could have clarified better on some things, but as I said, you know, last week was just laying down the foundation. I was trying to get you to mindset of like, okay, I need to be here thinking about these things. All right. It is a slight shift in paradigm, and that brings with it fear and uncertainty. Okay, you sat down in front of the computer, and okay, I'm going to mark up the homework, and you've been focusing on 15-minute, and maybe even some of you going down to the 5-minute and 1-minute, and now, oh, I'm supposed to be looking at this H4 and H1 confluences. When do we go down to the M15? Well, it's out of your comfort zone, okay? You're getting used to this one thing. Now it's a slightly different view. It's the same concepts, same exact method, but, you know, it kind of throws a little bit of a wrench into the works, right? And also, you didn't rewatch the video. I'm guessing, like a lot of people, you maybe watched the video once, and I'm not saying all you guys that handed in the homework didn't rewatch the video. No, I'm not saying that, but I'm sure there was a lot of people that didn't hand in the homework that were confused, and they simply didn't rewatch the video. So look, with these videos, especially because, I mean, this is my second session. This is the only one this is the second one I'm doing. This is the last out of the 2-parter. I'm trying to cram stuff that I could spend months talking about into these 2. So you got to go. I'm going to be going fast. You got to go back and watch it. Watch the video this first time. Watch it again the second time. Watch it a third time and take notes. And then a fourth time, watch it with your notes, and then, you know, apply it to the chart all these times. Like, go back, pause the video. It's video. You could pause it. Go, mark up the charts, send me a snapshot, and say, is this right? Cool. It is? All right, then I'll keep doing it, and I'll send you the template. You know? Don't just watch the video and try to absorb through, hey, you know, all right, so I don't get these H4 levels. Now, it's kind of my fault. Actually, it's pretty much my fault. I used the term levels and I shouldn't have, okay, because I want you to think in consolidation and ranging, not, okay, 1, 2, 3, peak, reverse, all right? I tried to make that distinction last week, but I don't think I was clear enough. Save that stuff for the H1, all right? H4 is going to tell you how to approach a market. As I see it, you know, and this is the stuff that I've come to see about the market from the homework, and that's why I got asked to come show you this. You simply need to identify what type of market you're trading. I call it the phase. You know, what phase is the market in? All right? And Steve used to approach this. He used to talk about this. He used to have a profile that was all moving averages of all the different pairs. And I remember in OTA, Carr can attest to this. He had the different profiles, H4, H1, M15, and he would show you all 3 charts with just the moving averages and go, okay, what direction are you trading? 5 seconds you had to go. Okay, so you had to look at the H4 and go, okay, the trend is up. H1, the trend is up, and TDI, you know, RSI TDI is at extreme. Okay, so this is that, and that means this, and so I'm looking for the reversal of P formation on the 15-minute. Okay, all that in 5 seconds. You had to just know, and we all blew it horribly. It was the first time we all took the class, but he always talked about this. So this isn't a divergence from the original idea. Okay. Now I'm going to cover all this in greater detail, but I simply wanted to get your feet wet. Looking at that H4, some experience, just get your stick your neck out and just go, hey, let's see what we can do. Doug said let's look at levels and consolidation. So I just wanted you to see it as more than like, it's just, oh, H4, that's the harmonic time frame, right? Okay, so confluence, it's just, remember, multiple criteria for multiple pips, and it's simply a collection of various things occurring on the chart at the same time for added confirmation. Which ones? Larger structure, is it part of a structure segment, a midweek reversal, false move week beginning? Is price going towards or hitting a QP, 50 pips above or below a QP? Psych levels, larger moving averages, the price is headed towards. Projecting out, are you seeing a moving average moving towards one of the other areas of interest? Zone flips area, 3 aggressive moves, TDI, shark fin, fixed 50, baseline bounce, baseline divergence, all this stuff we're going to be talking about. And again, thank you, Jim, for saving me a couple slides on this. So I was going to go into it more. But if anybody is confused, go back, watch Jim's video last night. He did a wonderful, huge presentation on all the different confluences that he looks for. And for everybody that knows CAR's 5 rules, that's a confluence: trend, stop, hunt, shift, TDI, etc. Pattern. That's a confluence. He's looking for those 5 things to be happening at the same time. So that's all a confluence is. Now, I can understand some people might be like, well, I wasn't sure what confluence is. Okay, well, we'll get to that. And I did cover it last week, but again, we kind of just glossed over it, just like here is what I'll be covering. So the baseline bounce is a particular occurrence on the TDI after or during a peak, which is typically divergent from price, in which the RSI has crossed over the market baseline and the signal line already, and comes back to bounce off the market baseline before continuing. Okay? Tap-ins, counter trend, peak, like if you're down 3 days, 5 days, etc., you have a big move down and you start to see a peak, you get a peak. After the second leg is put in, or the second shoulder, the second leg can be highly divergent, where the second leg is actually above the market baseline. Let's say we have a peak formation low, or and the second leg gets put in, but it's the same level as the price, but the RSI it's just tapping the market baseline. We'll see an example, plenty. Or second shoulder, which is often part of chopstick divergence. We'll cover that. All right. Again, I know I'm moving fast, but come back and watch the video again. We'll have some questions. Continuation, of course. Post-peak, level 1, your safety. You might get a normally divergent peak. Safety gets put in. The peak formation gets anchored. Safety gets, or the level 1 gets put in closer to the extreme of the structure. Your safety comes down. Visible stop hunt. Maybe it's even a straightaway, bounces off the RSI, the 50, and on the RSI, on the TDI, you're seeing the RSI bounce off the market baseline, that kind of thing. And of course, the same thing on the reset. You'll see these by doing the homework and some of the examples we're talking about. Okay, and sometimes it's a near miss or a flyby. Okay, sometimes it doesn't have to always, preferably, and a lot of times it does tap the market baseline, but sometimes it comes within like 5 pixels of it, and it scoops up. If the pattern is there on the chart and there's other confluences, don't let that go, oh, well, that's invalid. That's not a baseline bounce. Okay? Sometimes it scoops and bounces off the signal line. The reversal, the momentum from the reversal is so strong. So, and of course, sometimes it actually goes past it and it's a baseline shark fin. But I don't mean like it just goes under and it hangs out and then eventually comes back up. I mean a real shark fin where it's like 1 candle, 2 candles, put it down, 2 candles, put it back over. That kind of thing. We'll look at some. But here's an example, okay? We have 3 drives up, okay? We have an M formation, second leg above the first, okay? We're overextended. We're back inside the bands, comes back. That last leg, if you want to look at this as like three drives, I heard that term today, 3-drive pattern. But if you see this for what it is, this M formation, second leg above, pin, 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 comes back down. What do you got? Baseline bounce. These are gold. These are really, really gold, especially if they're on the second leg or the second shoulder. Okay? So H4 consolidation, they're not your average levels. Looking for consolidation as far as tight and large range bound. That's it. If it's not one of those, it's trending. Okay? I do not count on the H4 anymore. I tried it. I used to. Looking for L1, L2, L3. I don't do it. That's for the weekly cycle, all right, the benchmark. You know, as per what I'm showing you, all right? I know some other people count the H4 and they look at things. I'm just showing you what I've come across, okay? And, of course, the confluence of events, I think that's covered. All right. Market conditions. Identifying the current phase of the market on the H4. We'll use a little bit of D1 for this, but on the H4, okay? There's two primary phases, trending and range bound. Now, there's slight variations, only two that I really consider, but honestly, they're so, don't even worry. It's trending and range bound, okay? The only other one out of the other two I would consider would be a trending range bound or a range bound trend, which, you know, that would be like, well, how the hell do I distinguish? You got trend, you got range bound, and you got a mix of the two? Don't worry about it. Don't worry about it, okay? Even that, the way to really distinguish, just if you're confused, head up to the D1. It'll become obvious, and I'll show you. Okay, so do me a favor and just suspend how you've been trying to think of levels on H4 and just think in those terms for now. Don't try and apply the H1, the market maker cycle levels to the H4 just for now, okay? You know, it's like trying to train a cat like you train a dog. You're banging your head against the wall. I see somebody has their hand raised. I normally wouldn't do this, but yes, Mario? Getting some lag. Thanks, Joe. Yeah, I meant to turn that stuff off after we had our talk, but yeah, just got to plug forward. Sorry, I thought that person that raised their hands had a question. Sorry to interrupt the whole thing. Okay. All right, so we have the trending and the range bound. Oh, okay. Yeah, I got a little distracted there. We covered that. Okay, so what are we looking for? The trend can be your friend, but it also can destroy the hell out of your account, your confidence, your self-esteem, etc., especially if you're trying to counter trade it. I was so happy a couple weeks ago when Steve came in and started talking about, like, you know, the 80%, you know, of the successful trades are in line with the longer term trend. Or I'm paraphrasing. I don't want to bastardize what he said, but, you know, he addressed the problem most people have is trying to trade his method as counter trend, like, oh, just you know, constant 3-day down. No, it's different. You got to handle things differently. So, what the hell does a trend look like? Okay, EMAs, you have angle and separation, clear angle and separation, and I'm going to show you. I know I was going over this stuff with somebody else last night one-on-one, and they were trying to identify. They were pointing at stuff that is range bound and going, oh, well, that's angle and separation. Angle and separation doesn't just mean, okay, the moving average is pulled away for a little bit, like, ooh, I can draw a trend line between them, so that equal. No, you need clear angle and separation where they're just fanned out. Okay, 50, 200, 800 stacked and spread. So 50 over the 200 over the 800, or 50 under the 200 under the 800 for a downtrend. Okay, 50, 200, 800 above, 50, 200, 800 below. Okay, I'm sure you get it. 513 separation with, well, I just call them kissing, like, oh, look, it's kissing. On the H4, this is all H4 stuff, okay? This is H4 right now. All right, TDI. Your market baseline shifts to the other side of the fixed 50 and is consistently on one side of the fixed 50, all right? Market baseline. RSI is repeating extremes, which is maintaining a general state of overbought or oversold. This stuff is important, all right? RSI at upper bands and fixed 50 for pullbacks, constant shark finning these areas, all right? Those two, like, I cannot emphasize those enough. Pricey stuff, all right? Tighter consolidation appears here. All right, the stuff that hovers, it's been down 3 or 4 days, and it's hovering, and it's hovering. It's been down maybe a week and a half. It's hovering, it's hovering. You're constantly convincing yourself, oh, there's a peak, there's a peak, there's the W. And some of these do turn into smaller structures, smaller cycles. I kind of dub these 3x3s in my charts, but they're simply the cycle. You know, I used 3x3. This is before we called anything the benchmark, and I didn't feel like typing, you know, market maker cycle. But these are also smaller constructs that screw people up because, and I was talking about this on Sunday. I know some of you aren't in the the study group, but we were going over the homework. A lot of people get screwed up. They get like a 1350 cross on the H1, and price is starting to go up, and 50's about to cross the 200, and they're looking for stop loss, and then it shifts back down and it keeps going. Yes, it's a reset, but that 1350 cross gets people thinking that, oh well, yeah, I'm just automatically going to get 3 days of rise. It doesn't have to do anything. So, but these are where you get these tighter consolidations, these smaller cycles in these trends, and they screw you all up. Lots of awesome zone flips and pullback zone rejections. Okay. Awesome. If you're looking to the left and projecting out and looking over where your trap zone areas are, where previous trap volume is, or I always like to say, where was the last place that people got screwed? I say it a little bit harsher, one-on-one, but that's the general idea. So these are all loaded. They're loaded with resets and continuations and consistent overbought and oversold that mess you guys all up. All right. Now, how to handle the trend. You want to trade in line, okay? Your entry points. You're in line with the trend, okay? So those are pullback zones and zone flips. Because I'm not talking about like, oh, you catch it. I'm saying you go to the market and you identify you're in a trend. Okay, how do I trade this? If you insist, and everything is trending and you only have some trends to deal with. Okay, pullback zones and zone flips. Those are going to be your primary areas you want to look to get in on the trend. You see a trend, you don't just jump in, okay? Shifts, obviously, out of a previous area. We're going to be looking at this stuff, so don't worry. Structure segments, midweek reversal, false move week beginnings. These are fantastic, okay? Especially if the false move week beginning is part of a middle of a structure. A structure, when I talk about this, is just, a lot of times the middle of that, we think, oh, well, that has to happen on the false move or the midweek reversal. No, the middle could occur as the false move week beginning, and it's fantastic. Second leg, structure segments, okay? Oh, I cut out there for a second. Second leg, midweek reversal. Second leg, false move week beginning. That's kind of what I was just talking about. This was what I was just talking about. Now, scaling. These are your session setups, okay? This is down in the M5, looking at all the confluence stuff that Jim was talking about, and the patterns that Carr talks about, the confirmed patterns, and that's where you want to scale in, okay? And specifically, you want to be looking at your TDI H1 extremes only, all right? Your H4 is going to tell you where you should be looking, like where you are on the trend, and then when you dial down to the H1, you're going to be looking for H1 extremes. We're going to look at this. I'm sure, but like, what the hell is he talking about? Okay, so you want the band spread and the RSI smacking the bands. Okay, shark fin near the extremes, divergent at extremes. Okay, this is where you want to scale in. If during these structure segments, especially, because don't forget, in a trend, this kind of stuff is going to be happening mainly during these smaller consolidation areas. Okay. So take profits, scaling out. Basically, you want to scale out when you're taking profits, but you want to be looking forward outside of the trend. So if the trend is down, obviously you want to be looking further down, okay? Not just, we're talking in the swing line here, not just 50 pips or whatever, okay? The only difference is when you're trading back towards the first leg of a larger structure, okay? That's 2 bullet points away. So obviously quarter points and sweet spots, okay? The trends tend to run in 250 to 500 pips, sometimes 750. So a lot of times it's just easier to book at your quarter points, okay? When you're in a nice trend, you're going to be scaling out and in, you can, or you can just get in on one entry and then get out at a quarter point and just call it 250 pips for the week and you're good. It's up to you, but these are some of the things you need to look for. H4 RSI at extremes crossing back inside the bands and over the signal line, okay? You're coming down, downtrend, downtrend, downtrend. The H4 is outside of the bands. It comes back inside the band, starts crossing the signal line. There's a good signal, you know. The H4, 5, and 13 cross, and the 5 getting into the 50 as well. As I forgot to add the 1350. I'm sorry. Okay, these start to signal that, like, you know what? It may not reverse, but it's starting to go into, it's a potential that it could be going into consolidation. And if it's going into consolidation, then, you know, hey, why sit through all that? Because sometimes even the smaller ones can last for a couple weeks. All right? And, of course, your D1 H4 AOIs. If you're in a trend, it just broke out of a smaller consolidation area, and there's nothing really. You're looking at your chart. There's nothing to the left, no trap volume, no moving averages. You're well below the moving averages. You know, we're in a downtrend. Scale up to your D1 and look at those D1 trap zones that Jim talks about, you know. Okay. How to handle the counter, I wouldn't really bother, but if you got to, just do second legs on larger structures, okay, and second leg harmonics. We'll look at some of this stuff. Only scale on safeties, really. So if you get a second leg larger structure, okay, I would only, you know, let's just take a look real quick, all right? So you're down, right? You're down. Trend is down. Maybe you just come out of some consolidation over here, okay? And now you start to get a larger structure. If you're trading counter trend and you see this stuff and you go, okay, you know what, Doug said that typically they go down 250 to 500 pips and before they start doing consolidation, and in a stronger trend they do consolidation. Let me just get rid of this. They do consolidation and they'll range for about 250 pips, which I get to. I haven't gotten to that yet. And these consolidations will typically fail. If you're in a stronger downtrend, these consolidations can fail. This is where you want to scale in. Like that's pretty much it, because you don't know if this is going to go all the way up to the 250 or if it's going to come up to like right about here and then come down. You'll still see 3 up, 3 down, okay, into these structures, and then really, Doug? Okay. And then what will happen, you'll see this, and then it starts to fail and it rolls over. And then it continues going. It starts failing pretty much around this area, the top of this area, the bottom of this area, kind of zone. Can you see the zone flip there? You see that? Okay, so if you're trading counter trend, what I'm trying to say, you're trading counter trend, and it's a strong trend, if you're taking this, the only place you want to scale in is here. That's it. Get out after you see 3 up. You try and take a middle. This is what I'm talking about, a middle of a larger structure. We think about this as far as midweek reversal, but sometimes notice the way I drew it, you can have the false move week beginning as the second leg of a middle, because often you get those large W's. I'm sure you guys have all seen this. You get those large W's. What do you get? You get an M in the middle to go back to form a larger structure. Now you got one of two things. It's going to come up or it's going to fail, and it typically fails around this the second push down, or the first level back up, at the bottom of the first push down. It fails there a lot, okay, and then it rolls over. So that's why specifically when I talk about taking second leg counter trends, okay, the second leg of the larger structure, if it's against the prevailing trend, you're going to want to, at the most, get out up at the middle, but you should be scaling out at previous price points in these areas. And we'll look at chart examples, obviously. Okay, so take profits, the middle of your structures. That's what I was just talking about actually there, the middle of the structure, taking that second leg back up, right? You want to be getting out towards the middle of your structure. But better yet is that second leg, that second level of the second half of the larger structure. Okay? If here's your larger structure, 2 weeks, right? It's not 3 up, 3 down in 1 week. The benchmark. This is a larger structure. You want to be getting, this is your second push down into the leg. This is your second push down. This is where it fails a lot. So that's what I'm talking about there. I kind of got ahead of myself. Take profit at zone flip territories. Okay. If you see here, they may have come up and spiked this. I'm kind of just drawing like a line chart kind of thing. But they broke through here, didn't they? They broke through here. Perhaps this was a zone flip up into this area. You just kind of want to trade counter trend, looking to the left and looking like, well, again, where's the last place people got screwed, and trade accordingly. Like, know where your take profits are, or where price is most likely to reject and head back in the direction of the larger trend. And really, ultimately, try and focus on your smaller take profits of 50 to 100, or just whatever is available to you, given all that criteria. We are looking at this stuff. We're going to go to a chart actually right now. But just a quick thing about zone flips. Sometimes in a trend, sometimes they're not bottom of a previous range, but rather where price broke through a major price point, such as a 000. Remember what a zone flips function is, and that makes sense. Okay, zone flips function is what? To take out the break even of the breakout traders, right? Especially those big dogs. Small talks about them. So there was no structure here, right? There was no, they didn't stop and produce a structure, because a lot of times we most of the time, a lot of the times anyway, I don't know how much, I haven't done any statistical analysis, but what do we see? We'll see a range, and then it breaks out of that range, and the zone flip is to hit that area. But imagine this is 150, okay? Imagine this is a 000. Okay, we just came from 55, 52, 50 down to 50, and it just shot straight through. Okay? Well, there's a lot of people, oh my God, it broke right through 000, broke right through 150. I'm going short. I'm jumping on. So what will they do? They'll come up and they'll hit that area. Now, a lot of times what you'll see, and this is really cool, they'll flip the zone slightly. For all the retail traders who don't follow the rules, if everyone's watched Paul's video, what does he say the rules is? Don't move your stop on a breakout. Don't move your stop until the next one down. Well, they'll come up and it'll look like, oh, that's the zone flip, and they're nailing people that have jumped the gun. Okay, all the retail traders, the ones going, oh, I got to lock in my profits. So they hit them, then they create that next level, right? For all the people that are following the rules, and then they start giving 1, 2, 3, boom, oh, ping, boom, 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 boom. All right. So I just wanted to illustrate that for the zone flips. Okay, so before we look at the chart, what do you do on a trend? First, you identify D1, H4. Okay, all those criteria we talked about. Drop to the H1 to focus on consolidations and continuation behavior. Continuation behavior being, the pullbacks, the zone flips, the RSI on the TDI. You want to know where the baseline is. Is RSI rolling at the extremes? That's the stuff that's going to tell you. Quarter point ranges and ADR for take profits. You're in a trend, like I said, 250 to 500 pips. If it goes 750, usually that extra 250 is to really induce before they come back and flip that zone. Follow the trend and watch the 513 for the first signs on the 4-hour that it might start to consolidate. Add this into your exit strategy too, and enter on the lower time frames. You can enter on the H1, but you better do your homework and have confidence in the shifts. You have to. Okay? I'm reiterating this before we go to the charts. Dial down to the lower time frames and tighten up your entries on this stuff. Study the hell out of this stuff, because it's going to give you the confidence to know how to handle the market. That's where everybody gets confused. But you still should be dialing down. I'm so freaking proud of Tim. Watched the video once. I barely covered the stuff I'm about to cover, and he's like, oh, he's okay, 50 pips below the quarter point. I'm watching it. It's doing this, and so let me dial down. I identify what he was talking about, even though, I'm just doing the homework now, and let me dial down, tighten up the entries. Nailed it. So until you're nailing this stuff, and you have done several years worth of H1, H4 markup, don't bother with the deep H1 shift entries. Now, you can go and do 5 years and then practice this stuff on the hard right edge and hone your skill, but don't just jump right into this stuff and go, oh yeah, I did 6 months. That was the homework, right? So now I'm free to trade this stuff on the H1. You know, Doug said a trade doesn't matter, the stop doesn't matter if you know what you're doing. No, no, don't misinterpret me. Okay, so you have to know this stuff cold to pull this stuff off. For now, use your H1 candle patterns as added confirmation. Those star patterns, the second leg, shift and close over the 13 and the baseline. Use that stuff. See that it's coming, okay? That's the important thing. It's about projection, then dialing down and looking for that, you know, that tighter stuff. And that's where, you know, if you go just listen to Jim and Carr and Joe talking about, like, okay, down in the 5 minute and the 1 minute with Jim and Paul and all them and Carr and Joe talking about the shift over to the 13, waiting for the confirmation, you know, strict, you know, the original Steve stuff, that kind of, you know, listen to that in conjunction with this. Use that for your entries and this for knowing, okay, I'm good for a couple days. All right? So the only exception are retrace pendings, but that's the same concept as Carr. All right? That's it. Shift candle, 50%, 33. There's more advanced pending stuff, but we're not even getting into that. I talked to Steve, and I said, you know, he was like, I know it's a different animal. You can talk about it, but I decided I'm not until I know you guys are knocking it out of the park with this, okay? So, what am I talking about? What the hell is he talking about? Quick thing, I forgot. As I'm scrolling and I'm talking, that doesn't really work. So apologize about that. I'm going to try and remember not to do that. Okay, actually, I forgot. Things first, I do not have the price line grid on the H4. That was another thing. A couple people got a little like, oh, this is too noisy, it's too much. And also, if you don't like the colors, change it back to gray. That's fine. I actually got an email. Am I allowed to change? Yeah, you can do whatever you want. It's not. I don't care. I'm not offended. I modified somebody else. I mean, Jim had it developed. I don't know who developed it, but Jim had it developed for his AFP stuff and seeing the prices. I don't care. I just like to see it pop. However, it is too much noise on the H4. Okay, the H4. What did I say? We go and we look for a trend to see what phase we're in, a trend or range bound, okay? And this is starting a trend here. This isn't as clean as some of the other trends, but I'm going to use this for an example because more often than not, shorter term trends like this occur that you need to be able to take advantage of, okay? So we see on the 4 hour, okay, we have been in an uptrend. Do you see this angle and separation? Okay, and this is something I do on my charts. I want to thank Amir for pointing out how to use the rectangle a while ago. He had come into the Swingers Club for a little bit, and he was marking off, you know, I'm sure you've all seen his markups, and he'll mark like the little entry points and pullbacks with these little triangles. I was like, ooh, I didn't even know those were a thing. So what I'll do is to illustrate that there is angle and separation, my friends. This is angle and separation, okay, that the trend is up, right? So where is the RSI primarily? The RSI primarily in an uptrend is primarily in overbought, okay? And a lot of, except for like this deep pullback, the trend is rising. The trend is rising. Your RSI is constantly hitting the fixed 50 or the lower portion of the bands, which typically is around the fixed 50. Steve talks about all this in one of the boot camps, and what's funny is I've watched all the boot camps so many times. I have like 3 different notes, conglomerations for each one, and I never realized it until I just recently started going back. I'm like, wow, he talks about all the stuff that I basically relearned on my own from doing the H4 and H1 homework, stuff that I started seeing. So I was actually really happy. I was like, all right, so yeah, I'm not, you know, it's not MSU. So we see a shift, right? Immediately starts down over here. What did I say? The baseline crosses over and it starts staying below. Your RSI starts smacking into the fixed 50 and the bands, okay? Now this is very kind of choppy downtrend, but this is one of the more common downtrends that you'll see. All right, you trade this, okay? Because if you're just, here's the thing, if you're just going 1, 2, okay, is this, that's why, you know, the pushes and the levels and all this kind of stuff. I recommend you just looking at this and go, okay, well, I'm in a downtrend. We've shifted over, and I'm looking for, what did I say? You want to be trading trends with primarily the pullbacks, okay? I'm not recommending like, oh, well, it breaks out of this consolidation, get in here, all right? All right, I see somebody asked a question. I hope, let's see, date and year on charts. Oh, this is 2013. Sorry. I saw somebody ask a question. I'm like, all right, maybe am I cutting out? Am I moving my chart too much? Okay, so all your pullback areas. First of all, we notice, okay, how do we know that this isn't going to come down and do a larger structure, Doug? Don't you say you look for larger structure specific to your reversals? Yes, there's a couple of things here that I like in extreme shark fin. This is what I call a failed candle. Any day of the week, this is a candle that tells other people that the trend is strengthening up. Railroad track going into the end of the month, they cut over, then they give this false, again, another failed candle to the north side, right? They shift over. After that, where does stuff start happening? Zone flip at the quarter point, okay? They come back. Does anybody see this area in here? Down at the bottom of that candle where they broke through, shifting back here. But now, what I don't want you to do is look at this and say, okay, well, let me draw stuff on here. No, this helps you to identify we're in a trend. Okay, we're going to look at a different longer-term trend, but actually we're getting close to 8 already. I'm going to have to get to the range-bound stuff. Okay, so what you do is you see this stuff. Okay. Let's say you get to here. I'm going to be going down into oversold territory, and now I'm getting shark fin. Look at that little head and shoulders there at the fixed 50. Everything is lining up on TDI to indicate that a trend is potentially about to begin, a longer-term trend on the H4, right? Extreme down into the oversold, baseline over the fixed 50, and RSI is starting to stop hunt there. Now what you do, okay, is you go down to the H1, and let me just move this over. Actually, oh, got up there for a second. Sorry about that. Okay, my screen just froze up, and I'm not sure why. Okay. So you see this starting to happen. This is coming down. You're looking for what you want to do is you want to start your week. Okay. These are your weekly areas. Okay. You want to start your week just projecting out. Okay. Potential shift in the trend is happening, so you want to project out your areas. But you know this is happening. You go down to the H1. Once you're down on the H1, you have your price line grid, you have all this stuff. This is where you want to start projecting outwards and go, okay, these are my areas where it could pull back. Why? A trend is potentially starting to happen. I'm starting to get some angle and separation on the downside. It still could possibly be range bound, okay? But this is where we want to start to look for the structures to pull back into these areas. Now, this is a great example of this. we shift down. How many people thought this was a potential continuation? Okay, this is why I say, okay, where was the last place people got screwed? They didn't even come back up there, right? All they did was they started giving you a structure. Does everybody see this? Does everybody see the comes down 1? There's your little stop on 2, 3. Okay, and this is what I was talking about. Those smaller structures where you don't. Okay, the 13 crossed the 50. Now I'm looking for my safety trade, and I'm going to be looking for 3 levels up. And even I would potentially be thinking here at this point, very well could come back up here. But they throw this. They throw a confluence. Okay, we got a pin through the quarter point. It's a zone flip. All right, you want to be down on your 15-minute at this point. They shift over. They start rolling down into a more medium-sized structure. Okay, this is what I always call the 3x3 because it wasn't the full cycle as far as like, okay, level 1, level 2 gets put in, and 3 is 13 or 50 crosses the 200. Okay, so you see this stuff, it rolls over, and see what I'm talking about. See how it just kind of right into this area? Does anybody see this? You get this is what I was talking about on this. Remember, here's your structure. You got a trend that's happening. You get a structure. If you're not sure about a trend happening, okay, oops, sorry, I went to the wrong chart. If you're not sure about a trend that's occurring and you're not sure, oh, is this going to go back up, watch how they will handle the consolidation area when they throw you this 3 cycle, 3 up, 3 down, then they start pulling back. You can even see they got bursts here, burst, and then they hold right at that level, right at that first push down. There wasn't even really a second, but they stuttered for a second at that sweet spot and shifted, held, boom, shift, TDI extreme, out of the bands, and then we get a continuation of the trend. These are the kind of things you want to look for. These are the pullbacks, and notice all the pullbacks are occurring near the fixed 50 on the H4. This is how you're going to establish yourself in the trend. All right? Screws people up is that they start thinking, oversold, it's got to go up now. Oversold, it's got to go up. No, typically when you're in that trend, like I said, you're constantly at the extremes with the RSI, and the stop hunts are happening at the fixed 50. So you want to identify that with the H4, and then dial down to your H1, and go, okay, what am I looking for? See all these areas? Okay. We're starting to get a peak. It looks like a peak, right? Oh, looks like a peak. You get level 1, barely get level 2, and it constantly shifts down. That's why I will tell you a lot of times, you start taking stuff, don't take it past, say, this push down here. At the most, the first push down. I wouldn't even recommend taking it back up towards the middle. I mean, you can kind of see where people would start getting excited. We're at with the 000, okay? There's other retail traders out there getting excited that this is going long. This is going long. They're good. They're going to load up. So they're going to, most of them probably started loading up here. And what do? They stay out. So these are the kind of things you have to look for in these consolidation to know that you're continuing the trend. Now your range bound. I'll get back to the range bound here in a second. First of all, this is starting up. Are there any questions right now? Like I said, I'm trying to blaze through this. Say middle finger. No questions. All right, so the range. Now, the range is pretty damn awesome, okay? The price action on your range is the large range bound, okay? And we'll look at some, obviously. Tight and small, and those are occurring during trends, okay? So you need to know your tight, and you need to be able to tell the difference. And the real difference is the larger ranges will have your bigger 30, your larger EMAs crossing up and over, okay? The medium to range bounds, those can be like 250 pips during your trend, all right? And that's where you get a lot of those failed peaks where you get a second leg and maybe it goes up to the middle, but it tweaks out and it starts to roll over, okay? But in the range bound, you get larger ranges between 1 to 2 quarter points, can be up to 3 on the higher ADR pairs, okay? The tighter and the smaller ranges are about 250 pips. You get very clear 3 ups and downs, okay? Like, you know, the actual 2 to 3 day cycles. There's lots of profit booking to be had there, all right? Now, I did cover the indicator action, but the TDI, the market baseline, is on your 4-hour around the fixed 50, crossing back and forth. Okay, the market baseline is over the 50, under the 50. Same thing with the RSI. The RSI is ranging up and over the market baseline without real clear direction between the 40 to 60 range. All right? If we were to put a 40 and 60 line on the TDI, you're going to see that on the H4 when the H4 is range bounding. Okay? Now, H1 is your primary during the range bound. Okay? You just need to look at your H4 and go, am I range bound? Yes. Down to the H1 immediately. Trapped volume and to the left is your friend. Looking to the left, you know, trapped pins, volume bodies, stuff like that, which, you know, I'll show you in a second, talk about. Quarter points and sweet spots. They are hit, like I said, they range in between them. They extend them by 50 pips. They miss them by 50 pips, but generally they're smacking into them all over the place. But I'm talking at the extremes of the range. That's what you want to look at. Harmonics and second leg harmonic, okay? Second leg harmonic is where you get a harmonic box and it did some stuff in there and it kind of pulled away, but now it's outside of the box and you think, well, we're done with this, right? Well, the second leg comes down or comes back up to near that first leg or extends past that first leg, but it's still within the range, the height of the box, all right? TDI extremes both ways on H1, all right? You're getting a lot of up into overbought and oversold on the H1 because seeing as how we're ranging, it's at the extremes, all right? And, of course, the ranges, the actual price ranges are extended and tightened. They'll widen the range, then they'll tighten the range, all right? But still, the patterns, the stuff is so clear on the H1 during the ranges. So what you need to do is very similar. Identify D1 and the H4. Drop to the H1 to focus on the market maker cycle, okay? The highs and lows of the range. Lots of confluences all over the place. Breaks and near misses of the ranges. Harmonics fire all over. Look for 2 to 3 days, and that's it, okay? And, of course, enter on the lower time frames. Okay, so you need to be projecting out. Like, oh, it's going near the quarter point, and the moving average is coming in there, and it's going into Thursday, and there was a first leg yesterday. Oh, my God, I've seen this a million times. This is going to be a kind of later in the week, midweek reversal, you know, Tuesday, Wednesday, Thursday. It could be any one of those. It's diverged on the market baseline, and actually that leg that just occurred yesterday shifted below, and this second leg looks like it's bringing the RSI up to the market baseline. These kind of things, get ready for it. Dial down to your 15, your M5. All right. Now for the tail, we're going to go take a look, but I want to point some stuff out. Take profits. Do not try and nail it to the pip. All right. Do X pips plus spread in front of an area of interest, depending on the area of interest. Your volume bodies. I'll show you what I mean by that. I know I didn't cover that. 2 to 3 pips plus spread. Psych levels and EMAs, 5 pips plus spread. Sweet spots, 10 pips up to 25 plus spread. Remember I said they'll either extend or stop 25 to 75 pips in front or below a quarter point, okay? So if they happen to stop, and that's why I point out like the 50 pip sweet spot above or below of the quarter point. So if they stop 25, if for example, they're coming down into a quarter point, right? Here's your sweet spot. So what they could do, they could stop 75 pips to 25 pips in front of this quarter point. So if you really want to be safe and just lock in that profit, and you can get it into your system that you don't give a crap if it goes that extra 75 pips even, you want to lock in that profit, especially if it's getting towards the end of the week. What did I say? 25 to 75 pips above or below are their strike zones for around the quarter points. Well, if the sweet spot is 50, then 25 pips in front of that, you're coming into it, so that's in front of it, would be a reasonable place for your take profit, okay? Don't try and squeeze everything, all right? I know you all try to. I know I always did. So QPs 15 to 25, again, you got to do your homework. If it's moved 500 pips already and you're coming down near a quarter point, do the 25 pips. If you just came out of a range and it's only moved, 150, 200 pips, and you're talking about an ADR of like 125, you put it near the quarter point, 10 pips, instead of doing 25 pips in front of the sweet spot. So, but be happy like grabbing 180 to 220 pips on the majors, all right, instead of giving back 75 pips because you just had to place it right on the price line. I used to do a right edge entry simulations. I would mark my entries on the chart as well as where my take profits were, right? And I can't tell you how frustrating it is to be going bar by bar through your chart and constantly come up to 3 pips with your take profit, and it retraces by 50, 75, even 100 pips, and you're still holding on because you just held on for 2 or 3 days, at least simulation wise. Also, be aware of the confluences for your take profits. You need to project out with your take profits, okay? Do you see a sweet spot? Okay, cool. Just go a sweet, 10 pips plus spread in front of it. But is the sweet spot on or near the psych level plus the 200 moving average is approaching that from underneath, and it's likely going to be at there by the time your price gets there? Okay. When they have more price areas, when they have more areas of interest to smack into, they're more likely to approach it. If there's nothing there, and for example, price is coming up, and there's a quarter point there, but there's nothing really else there, you know what? Put it 25 to 50 pips in front of it, just in case, okay? But if you have the 800 is moving down into it, it's a 000, plus it's the psych level, or the previous week's low, that kind of thing, okay, put it near, like 5 to 10 pips in front because it's going to hit that quarter point. So the more confluences you have out in front of you, if you're looking ahead, the more likely they are about to actually smack into that area instead of, stay away from it. Oh, and the slideshow. So we're going to go back and we're just going to take a look at ranges. And I wasn't doing so bad as far as covering that. So what did I say? What are we looking at to start? First of all, coming out of a trend, what did I say? We start to look for consolidation and ranging potentially to happen. What? The first indication is the 5 starts to cross the 50, all right? And you see this wild behavior. Now, I know it's a little like, what are you talking about, Doug? It's wild behavior, no crap. But what else is happening? I'm actually going to open up the questions here. What would be helpful is if you could take us from preparation all the way through TP. Okay. Sweet spot. Down in the H1, I'm sorry, the sweet spot is the price line grid that Jim had developed. The second person is asking right after that, what is the sweet spot? I'm sorry, that's my own fault for calling it that. I mean, that is what it's named. Okay, I'll go down to the H1 and I'll show you. I haven't had a drink this entire time. Excuse me, let me mute that while the time frame changes. This price line grid, okay? Price line grid. I had one, Jim was kind enough to make one for me specifically with my specifications, but it just says AFP price line grid. I gave you guys this version, but you can just use the normal price line one. I just didn't want the 25 lines on there, the 25 price levels. But why am I calling it a sweet spot? If you hover over one of those lines, you get a tooltip. They're called sweet spots. All right. So that's why I'm constantly referring to them as sweet spots. Okay. So there wasn't many other questions. So I'll just take a look at this now. All right. So on the H4. Yeah, I'm sorry about that, Joe. I try mentally. I'm just like, oh my God, I want to take like a full lesson just to cover trends and then another just to cover consolidation. So I get a little ahead of myself. Okay, what did I say to start looking for? The 5 over the 50 and even the 13 crossing the 50. That starts to tell you something. But what I want to know is what else are we starting to see? Okay. That could tell us the trend might be starting to reverse. Yeah, Joe. It's overarching. Well, yes. This here, yes. This is a nice wider structure that you can see on the QP. I mean, this is the kind of stuff I like to see. And then you see this shift. However, coming down, how do you know? Is it going to fail here? Is it going to fail here? What's going to start to happen? Yeah, people are starting to nail it. Remember that when you're constantly in, you're oversold, you're in a downtrend, or you're constantly in overbought, you're in an uptrend. But the market baseline is starting to roll up, and the RSI is starting to tighten up. It's starting to tighten up. Remember, it's starting to remain between that 60 and that 40 line. It's still showing down, but the market baseline is coming up, and it's not buying it anymore. Okay. Now, people asked before all week, the market baseline bounce. Here you go, second leg, shark fin on the market baseline, but it's a baseline bounce. Okay. So once I see that 5, that 13, okay, you come to the market right here. It's telling you they're going to start range bounding for the most part, or they're likely to. There's no certainty. Okay. So when I said draw consolidation, draw ranges, what I expected was to see this kind of stuff. Okay. Now, when you get to the chart and you see this, you look, you go, okay, the moving averages they're crossing over. They rarely do just this alone. Okay. This was kind of a unique example, but they rarely just, okay, they cross over and drop without. You know what? They do that a lot more on downtrends, where people just they just dump and they get out of there. Downtrends happen a lot quicker. But you come to the chart and you see pinched EMAs. You see EMAs crossing all the big moving averages right there. Even if you're right here, you can start to expect, all right, you know what? There's 250. I'm looking primarily at this range, okay? When you're down on the H1, then you go down to the H1. It's as simple as that's what, okay, what am I looking at? I'm range bound. Cool. I know I'm range bound. I am now off of the H4. Okay? Now, to see these range bounds, okay, this is where you really get this bam, 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 okay? And what I talk about, the different ways to look at this, or the different areas of interest. Didn't I say 50 pips below the quarter point? Okay? So they start to set this range, and then they'll tighten it up. Okay? Because somebody asked at this point, why not look at a different pair? Because the same pairs, if you look at one pair, a trend will happen, and then a cycle will happen, a range bound will happen. So I figured might as well look at the same pair to do the two examples. We can look at different pairs. Actually, There's a good example that's strikingly similar to this pair. Okay, and what do they start? They hold a level. They're striking off of this quarter point. Okay, they come up. This is already a month they're doing this, but this is nothing. When you come down to the H1 on the H4, you're like, okay, it's range bound, but it starts doing this stuff. Ignore this. For swing trading, guys, for swing trading, wait until you see at the extremes. What did I say? Wait till the extremes on the H1 when you're in a range bound. That's it. Don't try, and yes, this is in the extremes, but they're not giving you too many clear things. You could look at this and say, all right, that's a stop hunt. I'm going to take this long. Well, what happens? If you do get it. Guess what? You see 3 bursts. You look over here. That's a previous trap area. They stopped just sort of the sweet spot. Get the hell out. These are the kinds of things you have to think of in these range bound markets. All right. What do we see over here? That was somehow my scale got screwed up. This is much better view. You see that now? Does it seem much clearer? Look at this. Just shift up, shift back down, go into consolidation. Then they rise. How many after a week of holding? How many? What's the count? Do we see? Right? 1, 2, 3. We get divergence. Okay, we even get a little baseline bounce here. They come back, they spike it one more time. They spike the sweet spot. Look how they stayed right off there, okay? Stayed right off that quarter point, shifted. There's your confirmation, baseline bounce. But at this point, when you're projecting outwards, okay, so what? You miss all this. Boo-hoo, okay? You miss all this up, big deal. You're not going to take it here. Trap move end of week, going into the next week. You don't know what they're going to do. So perhaps you miss all this because, hey, I only want to trade at the extreme of the week or extreme of the range. You're not trading Sunday going to Monday. This is London. You're a swing trader. You're not trading London because you can't. You miss all this. Then this New York right here. You start planning ahead. That's when you dial down your 15-minute because you're projecting out. You know this is your range. You're looking for stuff at the next quarter point. All your moving averages are tied up. You're in on the H4. You're in the middle of the range. You're looking for TDI extremes on the 1 hour. Your H4 is just going to be right between these areas during this pretty much this entire time. Okay, and you trade back down. And another thing that's going to be priming my thought for trading back down is the fact that I like larger structures, and typically they will do these larger structures. Okay, then we start to like maybe a trend back into the second leg, but I'm not taking it as a trend. I'm expecting if I'm looking at this down and I'm getting in on pullbacks, I'm only looking to get out to about here. Now, somebody asked about a different pair. What's interesting, scrunch this up just a little bit. Does anybody see? I mean, they hit this up here, come all the way back. Finally, I get my second leg. Okay? Now, take a look at something did not happen properly. Do not want that on the H4. I don't know why I put that there. Okay. So we're going to go to 2013, April. Okay. Here's what I want you to take a look at. I'll scrunch this up. This is practically different. And at one point, I think DJ, I love this setup, this structure. It's a wide. I mean, this is a larger D1 structure, but this is. They will do this. Look, they ranged for approximately like 5 months going through. Each one of these is a week. 1, 2, 3, 4, 4.5, and It took about another month and a half to get this little W formation in the middle. Okay, obviously they're trapping past this area, bouncing off that quarter point, back up. Do you see 750 pips? Okay, do you see the 250 pip range here? And they start screwing around here. They come up to the next quarter point, break it by about 75 pips. There's your blueberry. Okay, confluence of events, smacking into this area back here. Okay, shift back down. Where do they hover? They hover right in there. Come back down to the next area. Stop at the quarter point. Let's go back to the euro. Same thing, it's just smaller. Up. They didn't have to go far to the blueberry now, did they? Smack off that quarter point, come back down. Don't take this out. They don't even really, they come right back to the top of that area and work that for about a week and a half. They extend this range. I believe there should be a harmonic here. H4 safety trade, basically. A nice bearish butterfly. And then they come down and give you that second leg. It's practically the same thing. It's just a variation on the theme, okay? But the way you trade these, as opposed to the trend, is vastly different because you're thinking in this range bound. I'll leave it at this. In this range bound, you're thinking primarily to the left, where are they going to stop and reverse with trapped volume, okay? With trends, you're primarily thinking where are they going to reverse in the opposite direction of the trend, okay? If you have a strong trend, and this is actually a great example, you see the 5 is below the 13 consistently, okay? You start to get, 5 crossed the 50, I'm looking for range bound. Do we get range bound? Yes. What kind of range is it? 228 pips, actually down to the bottom. 245, okay? It just happens to be in the middle, and then back down into the middle. And do you see what they're doing? Aren't they shark finning above the bands? Yeah, but they're in oversold. They're in oversold. That kind of territory, all right? And they're not letting that trap volume out. And then they roll over. Once you get this, you start thinking differently. You start thinking 2 to 3 days, that's it. Area of interest, get out. At the mayonnaise. Back down to the trap areas. Okay? It takes some practice. You need to go through this, but just remember, 4 hour, identify what you're doing, or identify the phase, and then go down to the H1. That's it. And then look for all those areas of interest. And listen to what I said about the TDI. You're going to have to go back and listen to this. I know probably a lot of it sounded like gobbledygook, and it was one after the other. There's about a dozen concepts that I'm trying to stick into an hour, so I apologize if things didn't make sense. But I promise you, if you just do the homework, send it to me, I'll help you out. And one final thing I'll say is, I mentioned this in the beginning, when I went back to the original videos and started watching, I hadn't done it in a couple years, but after I did all this homework and I started going back, and now in the past couple weeks started watching a lot of the boot camps, I am amazed at, holy crap, that he said all this stuff that I started seeing. Okay? All that RSI, I thought, I'm like, RSI, we traded the extreme, shark fin, that's how it goes. All that stuff about the RSI and trading between the ranges and stuff, I never retained any of that. Like, I thought I was, I'm like, I noticed all this stuff. And then I went back and I'm watching, and he talks about that in the how to use the RSI and the what's the trend. I think it's in season 2 of boot camp. So watch what I'm talking about and go back and do the homework, especially now. And he even said at one point, it's hilarious, he even talks about, they break out of the range, drop about 200, 250 pips, and I was like, like, he's there. I mean, he never used the quarter points and stuff, but he still, those, go back, listen to all the stuff. I promise I'm not crazy. I'm not convoluting stuff. Use the 4 hour to your advantage by identifying what kind of market you're in. Is the 13.5 crossing the 50? Okay, we're likely getting into range bound, or we are in range bound. How do I handle that? How is that different from the trend? and then go down your H1 and approach your trading with the mindset of, I'm in this phase, this is how I handle it. And then look for your confluences, dial down your 15 and your M5, look for your entries. Okay? Yeah, I know, Greg. I am still a little crazy. Okay, so it's 8:21. Baby's already out with the bathwater. I'll give you 9 minutes. Joe typically doesn't talk to me for about 2 to 3 days after I go this long, so sorry, Joe. No, I'm teasing. So does anybody have any questions? I know there's going to be a ton of questions, but anything specific? Oh, great question. Do you hold over the weekend? I don't typically hold over the weekend. I just don't like it because of the anything can happen. But I have. The only time I'll hold over the weekend is when it's part of a larger structure that a trap move has happened on Thursday or Friday. Okay. Actually, it's hilarious you asked. Here's a great example, okay? This is obvious. To me, this whole thing, here's the thing about the homework. People are confused. This whole thing is range-bound to me, okay? That's one of the things I wanted to clear up. A lot of people were drawn, and this is stuff I used to do. I'm not making fun. A lot of people were drawn this kind of thing, and that's the kind of idea I want you to suspend for right now. Don't draw consolidation like thinking about H1 levels, like, oh, this is a level 1, this is level 2. Do they exist? Yes, but I just want you to look and just go, you know what? This whole thing is range bound. Because as soon as you get the 13 crossing the 50 and the 50 crossing the 200, this is the kind of crap that they do for months on end most often. Okay, so do I hold over the weekend? This is obviously free up, but there's a lot going on here, okay? We're finally up and we're hitting it overbought again. We have a 2-week structure, or actually a 1-week structure. Okay, that starts in the middle and goes to the next. So about a 5 to 6 day structure, several hits. Okay, do we see the market baseline bounce on the floor? The baseline bounce on a second or third leg H4 pattern is just monstrous. So this trap happened on about Thursday going into Friday. I'm holding this and it shifts down, then this I might hold over the weekend because they already did their damage up here. They already worked this area. So this I might hold because, you know what, I might hold for that extra 88 pips down to the quarter point. And damn it if they don't go there and then hold for about 2.5 days. So only in special circumstances when it's part of an actual structure. And another thing, this to me was the middle of a larger structure. And it is. I'm expecting, quote unquote, mid-week reversal for the H4, you know, like where they do the big structure. I'm expecting them to come down here. So watch the replay is good info too. Yeah. You don't pay attention to ADRs. Not so much anymore, okay? With a trend, I mentioned that one of the things you should pay attention to is ADRs. It's one of those things that can take the guesswork out of it. But if you do the homework, you're going to see that a lot of times not too much guesswork in it as far, okay, now I understand if maybe you listen to what I say and you go, okay, here's a structure, here's a larger structure that failed. Doug said, watch when you get a second leg larger structure, and it can't take out the middle. And they went and look, they just shifted to start the new week. And isn't this the middle of a potential larger structure here? So, you know, I'm taking it, you know, I took it over here and I'm holding down to the quarter point. There's some stuff over here that's a little shady. I wouldn't recommend getting in, even though you might miss this. But other people might look and go, okay, well, if you just measured 3 times ADR, you could see this was a peak and, you know, this was a reset. And if you could, or you could just say, you know what, it's coming, it's a stronger trend, this is clear angle and separation, and I'm looking for the moves that I know to occur down to the next quarter point 500 pips out of the previous smaller consolidation ranges like Doug talked about. Okay, these are the smaller consolidation happen during a larger term trend. Okay, and I'll typically break out 250 to 500 pips past. Here we get 5%, and it just keeps going. I don't care. When you're doing the homework and you're projecting these things out and you're practicing them, don't forget that if shit isn't happening on one chart, you got 6 other pairs if you're just trading the majors alone. I promise you, if you start thinking in terms of cycles, or not cycles, cycles on the H1, but phases of the market, and then approaching that market on the H1 appropriately according to the phase, your opportunities are there all over. You don't have to worry about, oh, well, gee, I missed that extra 500 pips because I only took 250 over here, and then they didn't give me a real pullback, okay? So will you exit at end of week and then re-enter at week beginning? Only if there's only if I get a second move. I like second leg false move week beginnings, okay? Second leg false move week beginnings are fantastic. Okay, let's pretend okay. If I was going into a larger structure, that would be something I'd be interested in when you get a second leg that also happens to coincide with the false move week beginning. I know every single one of you have looked and gone through charts and you'd be like, I don't see a false move week beginning here. I don't see a false move week beginning here. I don't. You're right a lot of times, especially because you're looking at a trend or something. A lot of times, you know, in the range bound, you'll see a lot more false move week beginnings. So when I say range bound, I also include the smaller ones that occur during the larger trends. You get 3 up, 3 down. I didn't even plan this drawing. I just drew this, and it didn't even occur to me that I was doing trap move towards the high on end of week. Okay, now your ideal structure would be something like this. Okay, trap move going into the weekend, and then you get something like this. Okay, this is what I mean. Second leg of a middle. Okay, this is the middle of this structure. You do the homework. I swear you're going to see this. You're going to fall in love with this shit that I'm showing you right here. When you get these larger structures, you get the middle that occurs over the weekend. Second leg, false move week beginning. What did I say? They give you a big W. You're almost guaranteed that the middle is going to be a smaller M. That second leg, or the first leg gets put in on Friday, possibly Thursday. They hold the level. They come out on Monday, give you that second leg. False move week beginning, it's over. It's golden. Back down to the beginning, the first leg. So that's the only time I will immediately enter. You know, I don't just go, oh, well, you know, they held the level over the weekend, so I'm just going to get in and continue short. No, I'm looking for some kind of reason to get in, like a pullback to all those confluence areas that I was talking about, all those areas of interest. When you talk about the market baseline cross, are you talking about the fixed 50 or the movable yellow market baseline? Yeah, if I say market baseline, I always mean market baseline. I'll say the fixed 50. So I'm not sure which context you were talking about. If I said something that you were like, oh, you're welcome, Ray. I think 3 times ADR needs to take into account pullbacks. Absolutely, that's another thing that gets people screwed up. Why did it go? It went two times ADR. It's like, and Steve has explained this. Okay, it's 3 times ADR. That's why he amended it, 2.5 to 3 times ADR, and something, you know, 2 times ADR. You might only get 1 times ADR, but you'll get this full 3 up, 3 down, and it's just a smaller cycle, but it screws with people because they'll get the smaller cycle and then they'll hit and they'll hit, and it's like, oh, it hit 9 times, it's going to go up. No, you get a smaller cycle or even a larger cycle, and it hits and it hits and it hits. You know, I know people get that confused with don't hit the high in front of me 3 times because I'll spank you. Well, that he's not talking about over the course of 3 weeks where it hit the second leg and then it pulls up and it just hovers and then it just and then it rolls over. Okay, so with the 2.5 to 3 times ADR, 2 times ADR, yes, you got to factor in those pullbacks. So that's why trying to accurately do that what he's trying to get you guys to do is to accurately or to reasonably project out 3.5 or 2.5 to 3 times ADR, so you can start looking for those reversals. But he's really talking more in a strict sense of like a 50 pip. You know, that's why he emphasizes 50 pips. What's his favorite trade? His favorite trade is the peak formation. Like, he loves peak formations. You know, that may have changed. I don't know. Maybe I'm going to get a message from him saying, don't speak for me. But he used to be, peak formations. That's his thing. Why would he take 50 pips if you can hold it for 2 or 3 days? Well, he says, what? 1, that's just his style, and 2, I want, he doesn't say this, but I'm wondering how many times he encountered enough of these peak formations in a trend where he said, you know what, screw it, I'm just taking 50. So here, he could get the 3 days, but that's just not his style. He said he just doesn't like it. He doesn't want to do it. He can't concentrate on other stuff if he's sold in a trade. But if he takes over here and you're trying to hold for 3 days, at least he gets his 50. So that's why if you're in a longer-term trend, focus on that. Does red news figure into the entry and first day of the swing pattern? If red news is there, I want nothing to do with it. I'll get out if I'm in something. I don't care if I'm up, 200 pips and I think it might go another 5. I don't care. Red news will be the death of you. It's twice a month or 1.5 times a month basically. With the really damaging stuff. I know other interest rate stuff and it can come out, but if I see red, that stuff is rare enough that it's not going to screw with you. Mike, quarter point grid. Mike Webster, you did the quarter point or the swing club at one point, didn't you? I thought you had this, but I think you moved too. You could be the wrong person. I'm just talking to somebody random. It's in my last video. If you go to my video, go to the presentation in the DMR video subforum, it'll be there. Okay. But as far as red news, no. Everybody stop. I know some people show, oh, look, I grabbed this. It's 1 day a week. If you don't have the discipline to not trade, and it's not even 1 day. I said 1 day a week. If you don't have the discipline to trade 1 day a month, and that's not even the day, one session, you can trade that Friday London morning. You might not get much, but there's still some cool moves that happen the London session. But if you can't have the discipline or forge the discipline to stay away from just that 1 day every month, or one Wednesday every 6 weeks for FOMC or whatever the date range is, at 2 p.m. when you shouldn't be traded anyway. I'm like, yeah. So I see red news coming up. The biggies. I'll that does factor into my trade. It makes me get out or not get in. I say, I'll wait. No big deal. If you're grabbing 250 pips in a week, 360 pips in a week, or some of the higher ranges that you can do on some of the crosses that I don't trade anymore. What's waiting a couple days going to do, right? Any other questions? No, it seems we are done. All right, look, start doing 6-month chunk homework, please. 6 months at a time. Just start on a January, go to June, mark up all the H4, mark up some of the confluences that you see. There's only going to be a couple of confluences and areas of interest that you need to see on the H4 in order to, or that you can't see on the H1. So just look at the bare minimum. Am I in a trend? Is this trending? Okay. Am I really sure? What are the criteria? Go back to the video. Do the screenshots. Write the stuff down. All right. Identify what cycle of the market you're in. Identify any of the smaller consolidation ranges that you see that I told you occur in the trend. And then go down to your H1 and then mark the hell out of it with your zone flips and your pullback areas and notice the TDI stuff that I talked about. Okay? And the same thing if it's range band. Just do 6 months at a time. Send it over to me. All right? All the people that sent in the homework, I am not ignoring you. I've been, busy trying to prepare for this. and so life gets in the way. But I'm going to get back to you on your homework. I promise it was not in vain. And even if I didn't, the homework's for you. It's not for me. It's just, but I know you need some correction, and you're kind of like a babe in the woods out there, and you're like, well, how do I know? So I'll get back to you. I promise. All right. So have a good night, everybody. Oh, how do the daily charts help? Oh, that's okay. Real quickly, and then I gotta, we gotta cut this short. If we take a look, for example, one of the variations of the trending markets, okay? Take a look at this. New Zealand dollar currently, it is in an uptrend, okay? If you look at the 4-hour and you go, okay, well, I see angle and separation, don't I? This is angle, but this is more of a ranging uptrend, okay? What? This is more of a ranging uptrend. It's all over the place, and it's kind of ugly. All right, this is where you would get confused and go, okay, what does my D1 look like? Well, hell, this is actually just a range. This is just, so that's what I would look at your D1 to help you if you're confused on what's going on with the H4. As I mentioned last week, this to me is D1, like this is consolidation for D1 largely. If you look at it, this is just D1 consolidation. Look at that. This is D1 small consolidation. So D1 consolidation is H4 range bound, okay? This is all part, look, I mean, this whole thing, it just broke out of there a couple days ago when it made that thing. For all this time when people have been looking, oh, it's up, it's up, it's up. Not really. It was just slowly getting up in there. And what do? They smacked into 170. Okay, and remember what I was talking about? Sometimes your triple zeros, the special note and the zone flips. Okay, you see there's a slight hesitation right here, so you could say, well, that's that kind of was a bottom, but really your last real area of range was right here. They just kind of smacked in the 70 and pulled away. Why? Because people breaking down in the set. I mean, ultimately, I'm looking at this. I'm going, yeah, you know what? I don't trust it for too much longer up. So this is what this starts to help me do. This is how I'll use the D1 to help to further clarify. I mean, the rest is just really obvious on the H4. You don't even need to go up to the D1. Aside from this, going up to the D1 to look at your previous, your trap areas that you just can't see on the H4. Okay, your trap areas in your price lines that you just can't see on the H4 because it's way over on the other side of the chart. So, all right, guys. Have a wonderful evening. If you have any questions, send them to that email I set up, which was, just real quick, in case anybody doesn't recall, it is btmmswing@gmail.com. Okay, so do that. Rewatch the video, study it, go back, listen to the boot camps, and put this all together, and hopefully, you can start to swing. All right. Have a wonderful evening, everyone. Good night. Fare thee well.